Very good morning to you, all of you students. We will continue with our topic on advanced capital budgeting. In our previous session, we have covered some of the concepts on RADR and certainty equivalent approach. In this session, we are going to do some of the questions to firm up that discussion and take our discussion ahead. So we will start with question number 7. So the question number 7 states that if investment proposal costs 45 lakh rupees and the risk-free rate is 5%, calculate the net present value under certainty equivalent technique. So students, I will keep on touching up the concepts again. Good morning, Mohammed. Good morning, Shailesh. Good morning, Shruti, Devansh, Uday. Good morning, everyone. So what does certainty equivalent technique said? That we have to convert our cash flows from risky to guaranteed and then apply the risk-free rate to arrive at NPV, because the cash flows are also excluding risk and the risk-free rate is also excluding risk. Hence, we can take that calculation. So we have been given expected cash flows. By expected cash flows here, we mean the cash flows which includes risk. Tariq, good morning. So first of all, we have to convert these cash flows into the guaranteed cash flows. Calculation of guaranteed cash flows. We'll put year 1, 2, 3, and 4. Expected cash flow 10 lakhs, 15 lakhs, 20 lakhs, and 25 lakhs. Okay, students. Then CE coefficient is how much? 0.90, 0.85, 0.82, 0.78. Hence, the guaranteed cash flow will be 10 lakh multiplied by 0.9, 9 lakh. Then 15 lakh multiplied by 0.85, which is 12 lakh 75,000. 0.82 multiplied by 20 lakhs, 16 lakh 40,000. Then 25 lakh multiplied by 0.78, which is 19 lakh 50,000. So I think the step 1 is clear. So Shruti is saying, can we revise the concepts in previous class for 5 minutes? Sure, Shruti, I will take that revision through this question itself. So what does certainty equivalent method said? And its comparison to RADR, risk adjusted discount rate. So the certainty equivalent method said that since your cash flows includes an element of risk, you have to first arrive what is the guaranteed cash flows. By guaranteed cash flows, what we meant is by excluding the cash flows which denotes the risk component. If you recollect my example in which I took 2 lakh rupees as the cash flow, 1,50,000 as the guaranteed cash flow and 50,000 as a risky cash flow. In that, the certainty equivalent coefficient was how much? 1,50,000 divided by 2 lakh, correct? So that's how we compute the CE approach. Now, since CE approach in the cash flow, it excludes risk. Hence, while taking the discount rate also, we have to exclude the risk. Okay. So that means in the question, the risk-free rate is given, which is 5%, which is exactly what we need, right? Because we have computed the guaranteed cash flows. Now we will mention present value at the rate 5% divided by 1.05, which is 0.952. 0.907, 0. 822. No, wait. 1 divided by 1.05. 8638, sorry. 0.822. Students, Tanisha. So if we multiply this with the guaranteed cash flows and arrive at the present value, how much that will be? That will be 50,34,570. This is the present value of cash inflows less cash outflow. What is the cash outflow? 45 lakhs. This comes as 5,34,570. Okay, students. Good morning, Mancha. So, the certainty equivalent approach, what it states is that you have to first calculate the guaranteed cash flow and accordingly you have to arrive at the NPV. Now, for 2 minutes, I will just discuss this comparison so that RADR is clear. So, RADR said that because of the risk element, you need to increase your discount rate. Once you increase your discount rate, it will reduce the NPV. And in this, we said that in RADR, cash flows are also including risk and discount rate is also including risk. Correct? Similarly, on CE coefficient, we said that cash flow should always be excluding risk, which is a guaranteed cash flow, and the discount rate should also be risk-free discount rate so that the comparison is clear. Okay, students, shall we move ahead? Because we have a lot of things to cover in today's session, questions along with the techniques and some important concepts too. So I would just take this ahead. Okay. Now let us come to the next technique. So students, till now we have studied probability as a technique to analyze risk. Then second one was standard deviation. We understood what is the standard deviation, variance, covariance, then risk adjusted discount rate, then certainty equivalent method. Now let's come to the other techniques to analyze risk in the capital budgeting. So the next topic that we are going to discuss is on the sensitivity analysis. Very, very, very important topic, students. So what does sensitivity means? So students, you can actually read the financial statements of any company, and in that, wherever the valuation disclosure required, in that it also asks us to disclose the sensitivity of value when the discount rate moves up or down or any other factor moves up or down. For example, the impairment testing is done. In that case, sensitivity analysis is also disclosed. Now, what is sensitivity analysis? Even beyond disclosure purposes, it is also used for lot of other decision making. So, to explain sensitivity analysis, I would that till now we have discussed capital budgeting. What is a capital budgeting? Okay, let's first of all try to answer this question. Capital budgeting is a model, right, of calculation. It's just like there are certain inputs. What are those inputs? Cash inflows. Then next input would be cash outflows. Next input would be, let's say, discount rate, right? So whatever goes into that model as an input are refer to those inputs. Then another one will be, let's say, time period. Broadly, I can tell, these are the inputs. Then this is the model. This is the inputs. This. So you will put into that model, you will put into that way of calculating the numbers. Then finally, we will arrive at net present value, right? This is an output. Okay. We will arrive at NPV. In your previous, let's say in case of CA Inter, you would have studied that apart from NPV, we also calculate payback period. We also calculate other things, but I'm restricting the discussion as of now to NPV. So the net present value is the output from this model. What is sensitivity here now? So sensitivity is what is the change in output when we change 1 unit of input. So students, sensitivity in any parlance or in any situation would mean that how much your output will get impacted by a single change in your input while keeping the other inputs same. So for example, let me first write change in output divided by change in input. And here we take one input change at a time. So for example, we are changing cash inflow. So we will only change cash inflow. We will keep other inputs same. Second sensitivity, we are changing cash outflow. We will only change cash outflow and keep rest other things same. So it is an easy concept. Right, Mancha. Impact on NPV changes due to the change in the variables is called sensitivity analysis. Perfect. So as I explained, sensitivity is very, very important because as I told you that we cannot estimate everything on a very accurate basis. We don't know after 5 years from now, the cash flows that we are projecting, whether they are going to materialize or not. Hence, it is important for the users to understand if cash inflow after 5 years increase or decrease by 10%, then what is the change in the NPV, which is as of today. Okay, students. Good morning, Anumula. So let's come to this question and understand the application from here itself. This is a question on sensitivity analysis. Yes. So X Limited is considering its new project details. What are the details? Initial capital cost is put as 400 crores. Annual unit sales is 5 crores. So they have given us the volumes. Please, students, do check. These are the unit sales. Okay, these are not the sales value. This is the volume. Then selling price per unit is rupees 100. So for 1 unit, the selling price is rupees 100. Variable cost is rupees 50. Fixed cost is rupees 50 crore and discount rate is 6%. Okay. Then what are they asking us to calculate is the NPV of the project, the net present value of the project for this. So which is very easy. So first of all, let's calculate NPV of the project. So let's start from selling price per unit. How much it is? Rupees 100 less variable cost per unit, which is 50 rupees. So that means contribution. So students, why are we calculating per unit first? Because in your costing, or let's say in the contribution topic, we would have studied that first the direct cost has to be reduced to arrive at the contribution and then multiplied with the units. then that becomes our operating margin, that becomes our contribution in totality to reduce the entire fixed cost, right? So the contribution per unit is 50. And then number of units sold are how much? They 5 crore units, right? So 5 crores is the number of units. Total contribution will be how much? 50 into 5, which is 250 crores. Okay. I hope this is clear till now. Mansha, we will come to that. So Mansha is asking variable cost per unit remains the same. How to account this variable to sensitivity? So we will, while we discuss the second part, Mansha, your doubt will get cleared. Okay. So the total contribution comes road. What is the fixed cost? Fixed cost is 50 crores. So cash inflow will be how much? 200 crores, right? So this is the cash inflow, 200 crores per year. Now calculation of NPV. So we can simply put year cash inflow, present value factor at the rate 6% and present value itself. Okay. So year will start with 0, 1, 2, 3. So 0, there is a cash outflow. How much it is? 400 crore. Present value will be 1. Present value factor will be 1 and hence the present value will be 400 crore. Then comes 200, 200, 200, which is the yearly cash inflow. Present value at the rate of 6 is 0.943, 0.890, 0.840. Then 200 multiplied by 0.9 comes as 188.60. 200 into 0.89 comes as 178. Then 168. And the total becomes 134.60. So the NPV as is 134.60. Okay, students? I hope this is a simple NPV calculation till now. Nothing to do with sensitivity, nothing to do with any of the changes, right? Then the next part comes as compute the impact on the project's NPV, considering a 2.5% adverse variation in each variable. In each of the variable, you compute the impact on NPV by assuming that the variable moves by 2.5% in the adverse direction. And they're also asking which variable is having the maximum effect. So which variable is able to impact the maximum on NPV? And they're saying consider the life of the project as 3 years. That we have already taken. So now 2.5% adverse variation in each variable will mean that first of all, the initial cost is going to increase by 2.5%, keeping all the other things same. That is our first case. Selling price is going to decrease because the adverse will be, it will decrease from 100, it will become 97.5. The third factor will be variable cost will increase. I hope Mansha, you're able to understand now because your question was around this. Once the variable cost increase, it will be a negative. It will be an adverse movement in that variable to impact the NPV. Correct. Then fixed cost will also increase, keeping all other things same. The last thing, the unit sold will also decrease from 50 crore or 5 crore to 97.5% of 5 crore. Okay. So let's make these different scenarios. So we will put all the scenarios compared to the base. Okay. So first we will write base. Then this is our A. Then in B case, we are changing the cash outflow. C case, we are changing the selling price. D case, we are changing the variable cost. E case, we are changing the fixed cost. Then lastly, A, B, C, D, E, F, we are changing the variable. Sorry, we are changing the units. Okay. This is a solution to the second part. Okay. So let's put all the things here. Selling price. We will again start with the same statement. Base case, it was 100. Cash outflow, it will be also be 100. But in this case, selling price will become how much? Selling price will become 100 multiplied by 97.5, which is 97.5. Here it will be 100, 100 and 100. Because in other cases, we are not changing the selling price. We are changing the selling price only in the case of selling price. Then variable cost. Variable cost will be 50, 50, 50. And here, which is the change in the variable cost, the D case, it will increase by 2.5%. So 50 plus 2.5% of 50, which is 51.25. Here also it will be 50. Here also it will be 50. So what is the net contribution? So the net contribution per unit will be 50, 50. Here it will become 47.5. Here it will be 48.75. Then this will be 50 and this is also 50. Then number of units. So number of units, first case it will remain same, which is 5 crore, right? This I'm writing in crores. Then cash outflow also it remains 5 crore, selling price 5 crore, variable cost 5 crore, fixed cost also 5 crore. In the last case, we will reduce it by 2.5%. So it becomes 4.875 crores. So Robin is saying, why not discount rate? So Robin, even discount rate is also a factor and even time is also a factor, right? So we can change that, but in this case, I have not taken. Okay. So the question is also not asked specifically because see, at the end, it is saying that considering the life of the project as 3 years and discount rate also, if you want to change, you can change. This is the thing. But generally, what we do not discount rate as well as the time we will study in the next topic, in the next to next topic on simulation, we consider them as the fixed variables. Okay, the values don't change. Hence, in our entire simulation also, we keep them as constant, which we have tried to do here. But if you want to attempt, you can definitely change the uh, discount rate. You can increase the discount rate of 6% plus 2.5%, which becomes 6.15% to check the negative impact on NPV. Okay. Mancha is saying, why are we changing this is against economics? No, Mancha, it's not change. It's not against economics. We are just trying to evaluate that which input has the maximum effect of changing the output. Okay. Number of units come, then total contribution becomes 250, 250, then 47.5 into 5, which is 237.5. Then 48.75 into 5, which is 243.75. Then again 250. And the number of units, it becomes 243.75. Now fixed costs. Fixed costs per year are 50. Here also it will be 50, 50. Here also it is 50. In the E part, we have just a second. Just a second, students. I think there is some issue. Yes. Okay. I hope it is visible and clear now. Yes. So we were here. So Suraj is asking, why did unit sold change only in last column? Because in the last column, I assumed that the factor which will change is only the number of units. That is why. So if you see in number of units column, only number of units column is changed. Rest everything is remaining same. In the fixed cost, we are only changing the fixed cost here. Right? So let's say the fixed cost will increase by 2.5%, it will become 51.25. So we are only changing this fixed cost here. In the variable cost, we have only changed the variable cost. Rest of everything is same. In the selling price, we have only changed the selling price. Cash outflow will come now and base case will be the same. Okay. So we have to keep other factors as constant. Only that change has to come. Then comes fixed cost, it's done. Then number of units also, it will be 50 rupees, 50 crores. Just a second. Just a second, students. I think I need to restart this application because there is some issue. I request everyone to take this question ahead and solve it. Meanwhile, I'm just restarting the application. Yes, Suraj, only one item should be changed at a time. Okay, let us try again. Yeah. So, just a second, students. I think I need to restart my iPad only then. Meanwhile, I would request everyone to please solve this question ahead because now the next steps in this will be how we can change the, sorry, in the next steps here will be to calculate the net cash flow per year and then to arrive at the present value. Once you arrived at the present value, then you have to reduce the initial cost. And then once you arrive at NPV, then we will have to calculate the percentage change. Just give me one more minute, students. So Anubala is asking, we will take change in one variable at a time only. Why don't we take change in more than one variable? That is a good question, Anubala. So in sensitivity, we try to evaluate the change by changing the one variable at a time. If we change multiple variables at one go, that we will study under the scenario analysis. That will become the scenario. Okay. That is our next topic only. So we will discuss that. But as far as sensitivity is concerned, we will only change one variable at a time. Okay, I've restarted my entire setup. Let us see. The problem should not come now. Yes, just a second, students. Yes, perfect. Yes, students. So we were till here. I hope it is visible now. And apologies, I think there was some issue with the iPad. Yeah. So we have calculated till fixed cost. So we will calculate now the net cash flow, net cash inflow, right? So 250 minus 50 is 200. 250 minus 50 is again 200, right? Then 187.50, which is 237.5 minus 50. Okay, students. Then 501, sorry, 243.75 minus 50, which is 193.75. Then 198.75, 193.75. Then we will arrive at the present value at the rate 6% we will take. Okay. And at the rate 6%, the present value annuity factor is 2.673. So we will multiply all these numbers with 2.673 because for 3 years, 2.673. So this is 534.60. This one is 534. Then the next column will be 501.19. Then the next column will be 517.89. Then the next column is 531.26. Lastly, it is 517.8. Okay, so then initial cost will, which is the cash outflow. So in the base case, it will remain same 400. In the second case itself, we assume there is an increase by 2.5%. So here we will increase. So 400 plus 2.5% of 400, it is 410. Then everywhere it will be 400. So if we reduce this, we arrive at NPV. So the base case NPV, any which ways we have already calculated above. So that amount is 134.60. Perfect. Thank you, Tanisha. Shailesh is also saying done, sir. Very good, Shailesh and Tanisha. Okay, so here it will be the second case, it will be 124.60. Third case will be 101.19. Fourth case will be 117.89. Then 131.26, 117.89. Right? Now we have to calculate the percentage change in NPV. So how we will calculate? So the base, we will compare everything with the base case. Okay. So 124.60 minus 134.60. Okay. That will give us the change. So 124.60 minus 134.60 divided by, sorry, 124.60 minus 134.60. This comes as 7.43 percentage minus, okay, minus 7.43 percentage. Next one comes as minus 24.82 percentage, minus 12.41 percentage, then minus 2.48 percentage, and lastly minus 12.41 percentage. So students, I'll just write formula here. How do we arrive at this? So for example, for this is 124.60 minus 134.60 divided by 134.60. For this, it will be 101.19 minus 134.60 divided by 134.60. So this is how the percentages are calculated. Similarly, for this one will be 117.8 minus 134.60. Sorry. Yes, Shruti, you're right. Because the question itself said that for every 2.5 percentage, it has to move in an adverse direction. So if the question itself specified that it has to move in an adverse direction, so the NPV has moved everywhere in the adverse direction. If you see, 134.60 is the highest NPV in such a case. Okay. Uh, we have to understand that which variable has the impact of adjusting it the highest, right? So because this last part of the question also says that for 2.5% adverse movement in a variable, please tell us that which variable has impact of moving NPV to the highest, which is very evident here, right? 24.82. So which is this 24.82? 24.82 is the selling price column, which is the C column, right? So we can say this, if the selling price moves by 2.5 percentage, it has the biggest impact on the project. Hence, the project is most sensitive. The project is most sensitive to selling price per unit. As for 2.5 percentage change in selling price, NPV has declined by 24.82 percentage. And this is the highest decline when compared to similar movement in other variables. Okay, students, I hope this is clear. We check queries. Yes, Tanisha is saying selling price, perfect. Mansha is saying I took the life of the project as variable. Life of project increased to 3 years, 9 months, approx 4 years. NPV is equal. That is right. But Mansha, life, right? Then we will study another session in another topic in our session today, in which we can't compare the projects of two different lives just by their absolute NPV. We have to adjust it So we will cover that part there. But as far as the calculation is concerned, you're right. You can try and Tanisha is saying selling price. Vishnu is saying, sir, whether all study metal questions will be covered in the class. Vishnu, I have circulated one assignment which has been uploaded on the portal. So we will be covering those. And in case you have any other questions, in any other query, in any other question, you can definitely post that. Shruti saying FC instead of why it is not 50 minus. Sorry, I just wrote Shruti. Fixed cost instead of 51.25. Why minus? Okay. So Shruti, the first adverse movement will be when you increase the fixed cost, not reduce the fixed cost. Okay. Okay, you're getting my point. So while the question has mentioned that you have to consider the adverse movement in variable, hence we have increased the fixed cost. Tanisha is asking, sir, we would have evaluated the impact of change in discounting rate also. So that's what I answered. Counting rate and time are generally two variables which are fixed. See, the discounting rate is in a way an outcome, not of the outcome of the way you finance the project, right? Let's say you are investing the amount from equity. So the cost of equity will become your cost of the project. Similarly, if you are investing the amount using debt and equity mix, then whatever is the cost of debt and whatever is the cost of equity, the weighted average will become the cost of the or the discounting rate. So hence, it's not dependent on the performance of the project. Hence, I have not included it. But if you want to really try that, you can include that and make the last case as well for discounting rate. So until unless quotient specifies, it is better not to take discounting rate as one of the variable. Okay. Anumula is saying in question it was given 2.5%, it was given only variance. Then we have to do solution for both adverse and favorable. Very good, Anumula. Then you can, yes, do both for both the favorable as well as for unfavorable. Okay. But the answer will remain same because what will happen, I think mostly these negatives will get converted into positives. So instead of negative 7.43 percentage, it will be a positive 7.43 or some different percentage that can be calculated via there. Okay. Okay. I hope is clear. Sensitivity. So just to sum up, the sensitivity is basically to assess the impact of one variable on the NP while keeping all the other variables same. So basically, we have now, let's say I'm just trying to build on the concept through this only. So if our selling price is the highest impacted, so what I will do is I will try to minimize the risk of forecasting or the risk of estimation in my selling price. Because I came to know that if my selling price changes by only 2.5%, it has a capability to change the entire NPV by almost 25%, which is almost 10 times, right? 2.5% to 25%, it is almost 10 times. So I have to be very careful while I try to plan the project on selling price front. Okay. Yes, Mancha, because why these negative values are coming? Because the question itself said that you have to consider the adverse movements in inputs. So while you consider the adverse movements in inputs, it will definitely lead to a negative amount. Anumala is asking here, initial capital investment, reduction in investment is also an adverse variance. No, no. Anumala, okay, Anumala is asking then, so the reduction in investment is also an adverse variance. No, a reduction in investment is a positive variance. Why? Because it will increase your NPV, right? What is the adverse movement in an input? So just don't think it from the point of view of input. Think it what impact will it have on an output. So if you increase the initial investment, then only it will be having an adverse impact on the NPV. Okay. Similarly, your cost, similarly your fixed cost, variable cost, all these will increase. Then only you will have a negative impact on your NPV. Okay. Yes. Now let's come to the scenario analysis. Sensitivity is, I think, covered. Now let's come to the scenario analysis. So what is the scenario analysis? Sensitivity, we covered that we will change one factor at a time. Correct? Scenario will mean that it's a combination of different changes in the inputs, right? Different scenarios itself. Now, for example, there is a scenario one which will say that, okay, cash inflow, cash outflow, and maybe discount rate also. Here we can take discount rate as a package because in one scenario, let's say we are funding from equity, in another scenario, we are taking a mix like that. So it's different scenario, 1,50,000, let's say 10%. Here the scenario two will be, it will change all the parameters, right? All the inputs, 1,20,000, 60,000, and let's say it remains same. So this is one scenario and this is another scenario. So we have to calculate NPV for this as well. That is where the scenario analysis comes. And then we have to compare both the scenarios. Okay. I hope this is clear. Mancha, we didn't consider probabilities because the question also had not given any probabilities. Neither we are supposed to do because probability assessment is restricted to calculation of the risk, to calculation of the mean. Here the project was given very simple. Okay. Now let's come to question number 9 and attempt this to take ahead. Okay. Yes. Question number 9 says that, and sorry, there was one query from the student. It was asking that whether we will cover all the questions from study material. I just forgot to mention all the questions that I've taken are from study material only, students. It's just that this certain questions I have dropped, which because of the paucity of time, are again I thought would be repetitive, but still if you feel you have any question in that, please feel free to ask that. Yes, question number 9. XYZ Limited is considering a project A with an initial outlay of rupees 14 lakhs. And the possible three cash inflow attached with the project are as follows. So year 1, year 2, year 3, they have given the worst case, most likely, and best case. Now they're asking, assuming the cost of capital as 9%, determine the NPV in each scenario. So how many different scenarios are there? Three different scenarios are there. Worst case, most likely, and best case. Correct. So they are saying you first calculate the NPV in each different scenario, which is doable. Okay, students. Then if XYZ Limited is certain about the most likely result in the first 2 years, but uncertain about the third year's cash flow, what will be the NPV expecting worst scenario in the third year? So it is saying the second part of the question is a bit different. It is saying that for the first 2 years, the most likely result is likely to come. This one and this one. But uncertain about the third year cash flow, analyze what will be the NPV expecting worst scenario in the third year. So the worst scenario in the third year is this one. So the cash flow for the second part will be 550, 450, and 700. Simple. And using that, we can calculate the NPV. So first calculate the NPV for all the three, which is the first part. Calculation of NPV for each scenario. How many years are there? 3 years. 0 for capital outflow, 1, 2, and 3. Okay. Then present value at the rate of 9%. We can mention that right away, which is going to be the same 0.917, 0.842, then 0.772. Then comes the worst case. Worst case is given first. So the cash flow and present value, right? The cash flow is how much? First year it is 14 lakh negative, right? So we can put the numbers in thousands here. 1400 negative. So the present value will also be 1400 negative. Okay. Then the next one is 450. Then the next one is 400. We're talking about the worst case. Then the next one is 700. Okay, so 450 multiplied by 0.917. That will be 412.65. 336.80. Then similarly, 700 multiplied by 0.772, which is 540.40. So the worst case present value, if we total everything, comes as minus 110.15. So Tanisha is asking, yes, Tanisha, I think it is not mentioned. I was also checking that in the question itself. So I think these cash flows are in thousands. Students, you can mention that as a change. So I think these cash flows are into thousands. In the question, you can mention this, okay? So hence it will be 4 lakh 50,000, 4 lakh, 7 lakh, like that, okay? Good, Tanisha, good observation. Then worst case then becomes most likely. Most likely the cash flow is how much and the present value is how much. So the cash flow for most likely again for the first year will be 1400. Then the second year will be 550, 450, 450, and third year will be 800. Present value we'll just multiply with the factor. 1400 will be 1400, 550 becomes 504.35, 378.90. Then lastly 617.60. In totality, it becomes 100.85. So this is in most likely, if you see from the worst case, the NPV has increased. Correct, students? Then the last one is best case. Best case cash flow and present value. Both we will write. Cash flow for the first year remains same, 1400. Next year it is 650, 500, and 900. 650, 500, and 900. The present value becomes, for the year 0, it remains same, multiplied by 1, 1400. For 650, it becomes 596.05. Then becomes 421.00. 694.80. The total becomes 311.85. So the NPV here comes out as 311.85. So three different scenarios, three different calculations. Only thing is that we have taken the different scenario itself. And in this question, the different scenario is only different because of the cash flow. Rest cash outflow remains same, which is 14 lakh in all the three scenarios. Okay. But we might get a question saying that cash outflow is also changing, cash inflow is changing, then compute NPV for different scenarios. In that case, we will calculate like that. Very easy and very simple. So I think sensitivity and scenario, only by name, they look difficult, but in practice or in actual execution, these are very easy and very simple. Right. Then let's come to the second part. So the calculation of NPV assuming year 1 and year 2 as most likely and year 3 as worst case. So NPV will be minus 14 lakh plus 5,50,000 is the first year, correct? 550, 450, and 700. Perfect. 1.09 raised to the power 1, 4,50,000, 1.09 raised to the power 2, 7 lakh raised to the power 3. So hence NPV becomes 23,871. So Suraj is saying scenario analysis is much easier. I am saying everything is easier if you understand, right? So the thought process should be to understand the concept, to understand its application, then you are good to go in that concept and in that topic. Okay. So even, okay, now I'll just spend 2 minutes to just recap for the previous session and in this session till now what we have studied. So students, we started our discussion with understanding the recent trends or the current trends in the capital budgeting, in which we said that inflation plays a very big role. And in that, we further bifurcated that into the real, nominal, that discussion went on. We said that nominal includes inflation, real does not include inflation, whether we talk about interest rate, whether we talk about cash flows. Then we said that changes in the technology as well as changes in the government policy have impacts on the capital budgeting. So those that was the topic for the current trends in capital budgeting. Then we went on to understand what is the or how is the risk associated and how do we analyze that. So in that we discussed about probabilities. We introduced the concept of standard deviation as risk or variance. We also introduced the concept of coefficient of variation to or to let's say to compare two different projects. Correct. And then we landed on to the RADR and certainty equivalent coefficient discussion, in which we said that either your discount rate needs to be adjusted for the risk or your cash flows needs to be adjusted for the risk. Then lastly, we covered two more important topics, which are very, very good from the practical standpoint and have a very good use from the practical standpoint, which is one is the sensitivity analysis, which calculates the impact on the output if you change 1 unit of input, or let's say if you change whatever unit of inputs that are given in the question, right? Then lastly, we tried to attempt a question on the scenario analysis where we said that rather than changing one input at a time, what will happen if we build different scenarios? Now Manjunath is saying why we took rupees 7 lakh. Because Manjunath, the question itself says that about the third year cash flows, they are not certain. But they have asked us to expect that worst case scenario in the third year will prevail. So we have just followed the question. Okay, Manjunath? Manisha is saying first 2 years we are sure to receive the cash flow. Here we should use risk-free rate, and in the third year we'll take RADR. No, 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 no. Manisha, we can't do that. See, first of all, in the question it has been given to us that there is a cost of capital at 9%. So this cost of capital is already including the risk. Okay, this is already including the risk. Further, worst case, most likely, and best case, all these three also includes the risk. It's not that risk is not included here. It also includes the risk. Okay. So see RADR and CE, certainty equivalent coefficient, these two questions are totally on a different concept, right? In general, the risks element, if not specified in the question, are included. So Anumula is asking, in scenario analysis, question will be in this model only. Yes, you will be given different scenarios. Will there be a question like sensitivity analysis where adverse variance is given and are distributed more than one variable? Yes, it can happen, Anumula. I'm saying from a question drafting point of view, any question can be drafted. Let's say in sensitivity analysis, right? However, to compute the correct sensitivity, only one factor needs to be changed at a time. But if you ask me theoretically, yes, that question can be drafted and it can come. So in which it will say that you change these two variables at one point of time, another keeping other variables same, then another two variables constant on the second base and keep it same. So in a way that will become a scenario question, Anumula. Okay. Yes, Manjunath, 7 lakh is the uncertain figure that has been given as the worst case scenario. So Haradhan Das is asking, will you provide for us the theory questions? So theory questions, see, like I discussed two topics which are relevant from a theoretical standpoint, which is one is the changes in the technology, changes in the government policies, right? So both of them, you can go through the theory which is mentioned in the study material, although I've discussed the concepts so as to enable you to understand it. Okay. Still you have any issue, please do let me know. Okay. Then comes the next important topic on simulation. Yes. Now, students, I request all of you to pay attention here because this is something which is a very interesting topic. So we will spend 10-15 minutes on this and then we will be done on simulation. But please do pay your 100% attention on this, right? So yes, students. So simulation. So students, I just wanted to ask all of you, first of all, what do you mean by simulation? What do you mean by exactly the word simulation? Just don't think it from the current topic parlance. Just think it from your general layman terms. What is exactly simulation? What do you mean by simulation? So whatever comes to your mind, please post on the query handle. Okay. So Guram is again asking, so Guram, in this question, please note one correction, which I have already told. So these numbers are in thousands, Guram. Okay. So the cash inflows for all the three scenarios are in thousands. Okay. That is why your query is coming. That will not come. Yes, students. Okay. Simulation. Suraj is saying demo. Tanisha is saying imitation. Yukta is saying anticipation. Very nice. Come on, students. Please post your thoughts. Again, I'm saying no one is right or wrong in this, right? Plus, please try to express what do you feel about simulation. Perfect. Devansh is saying to make conditions near to reality. Very nice. Tanisha is saying imitation of something or some methods or process. Very nice. Imitation means repetition, right? We are just repeating, and repeating. Anumala is saying having experience in real situations, but without being there, maybe virtually. Okay, very nice. So maybe Anumala is contemplating that so there is a pilot and he or she is there in a stimulating environment and he or she they are actually flying the aeroplane in a simulated model. Perfect. Shailesh, kind of model. Perfect. Mansha seems real, but not real AI. Okay. So, so students, please pay attention. What do you mean by simulation? I think all of you are correct in your understanding, right? In general way, simulation is actually repeating the same task, okay, for getting different outputs for different values of inputs. Okay. Again, I will say that input, process, and output. What if I keep on giving thousands of inputs, thousands of different inputs, huh? Thousand of different inputs. I perform the same process thousand times on different inputs and arrive at thousand different outputs. So this is called simulation because this simulation, we don't know that what is that exact input that is going to come in future. Hence, we are trying to assess all the different inputs that we can know as of now and try to arrive at an output. Okay. Now, how these inputs are derived? So, students, there is a process called, or there is a concept called random number. Okay. By random number, what do we mean is any random number, any random number you think. Okay. So those random numbers are used as an input in the process to formulate these inputs. So we are not scientifically arriving at those numbers. Okay. What do you mean by random number? Not scientifically arriving at those numbers. Neither we are biased to that. Okay, let's say I have a biasness on 7. So in the 1,000 times, I put 7, 8, then again 7, 1, then again 7, 2, then again 7, 3, like that. So I am always placing 7 because I have biasness. So I'm saying no biasness, no scientific way of arriving at those numbers. That is called as a random number. Random number can be, let's say, 11. Again, if you ask me, random number that comes to my mind is 25. Again, that random number that comes to my mind is 15. Again, some random number comes to my mind is 50. So there is no logic behind random number. Okay, there is no logic. The best way to understand this, if you open in your laptop or in your PCs, Microsoft Excel, in that there is a function called random. If you try to do that, every time it will throw a different number. For every enter, it will throw a different number. Okay. So that is how the random number, there is no sequence attached to it. Okay. Now, and why are we using random number? Because we don't want to base our output on any specific input. We want to keep this process. We want to keep this process of simulation very much open. Okay, students. Now, one more thing that we have to keep in mind. As far as simulation is concerned, there are two terms that we have to understand. Manjunath is saying simulation is the mirror of situation. Very good, Manjunath. I'm quite impressed with all of your thoughts. All the students are quite impressive. Guram is saying this chapter simulation is in ICMAI OMSM chapter. Okay. Maybe I'm not aware about this or some other topic Guram is saying. So, but you try to understand the concept here. Okay. So one is parameter. The second one is exogenous variable. Please understand this, students. Now I'm just trying to relate this to the capital budgeting. Okay, simulation parameter. What does parameter means? Parameter are certain variables which are by the choice of the person who is doing that simulation or that company for which that simulation is being provided is considering them to be fixed. Okay. For example, so if I just read the definition that is given in the study material, just a second. It says that parameters are input variables specified by the decision maker and held constant over all the simulation runs. Okay. For example, I was telling about the discount rate. Okay. Discount rate is kept as, let's say, same. We are not going to change the discount rate in whatever simulation we do because we are not simulating for different discount rates. We are simulating for different cash inflows, cash outflows, different cash flows, right? So and this is something that is decided by us. Okay. What is meant by exogenous variable? Exogenous variables are those variables that are beyond the control of the decision maker, but are dependent on the probability. So can I say that if I take a random number of 10% of, let's say, 10, right? And take that as an input to the probability, and that input to the probability, I try to arrive at the cash flow, and then using that cash flow, I take the NPV. Okay, so here the exogenous variable will be cash flow. I will try to explain it again with the help of the question. Okay, but please try to understand what is the chain doing here. We are taking some random number. That random number is used in the probability. Okay, how it is used in the probability? Let's say the random number is 10, it's 20, it's 35. So I will see against this 10, let's say 10% probability, what is the cash flow coming out to be? So if I say that, what is that cash flow that will be there on the 10% probability? Similarly, what is the cash flow on 20% probability? What is the cash flow on 35% probability? These are three different simulations, right? And hence, what is the NPV on three different simulations? Like this, there will be thousands of simulations. Okay. And hence, we will arrive at that NPV. Mancha is saying deep fake. I don't know whether it would be right to say or not. Right. So NPV is like this. Cash flow is. So here, while from calculating cash flow to NPV, cash flow becomes our exogenous variable, and the discount rate that we have used will remain fixed, right? Discount rate is not changing in the different scenarios. Hence, it is called as a parameter because we have kept that as fixed. Okay, students? So let us try to see this from the study material itself. Okay. Yes. So this is on page number 3.29. Okay. The 29th page. I request everyone to please open that, or just to focus on the screen. I will just try to explain the simulation through the example taken in the study material. Okay. So first of all, students, as I told you, there are two things that we have to first understand. One is exogenous variable, right? And the second one is the second one was the parameter. Okay. Now, if you see, students, in this question, the discount rate and the initial investment have been kept constant and are not changing. Hence, both of them are being called as parameters. It is up to the decision maker, right? I feel that in all the different situations, the initial investment is always going to be the same. Hence, there is no need to change it. Similarly, the risk-free rate is also going to be the same. Hence, I am not changing it. I've kept them as parameters. But what is going to change are two things. One is project life and second is annual cash flow. Right? So the annual cash flow, okay, let me put here in the screen. What are different things? One is rate of interest. Then second is initial outflow. Third is cash inflows. I would say yearly cash inflows. Okay. What will happen in the yearly cash inflows? And lastly, I will also say the time period. For calculating any NPV, these are the four bare minimum variables that are needed. Correct? Is there anything else also needed apart from this? I think no. So these two, I'm thinking to keep it fixed. Hence, I've called them as parameter. These two, I'm saying that let's keep on changing it. I'm not too sure about the time period also, and I'm not too sure about the yearly cash flows also. XO Genius variable. Okay, this is up to me. I have defined it. So let's say now you might ask, I can also say the time period in any other analysis I will keep as parameter. I will only change the yearly cash inflows, right? But in this, the way the situation has been drafted is we are keeping it as time period as exogenous variable. Okay, students. Now let us go back. Yeah, till now with me. There is one more term used which is called as stochastic exogenous variable. Okay, what is meant by stochastic? Stochastic is the output is dependent on some probability. Okay, as I told you, a random number will be used in probability. Probability will be used to come out with that exogenous variable, which is cash flow, and then it will be taken into the NPV. Simple. Okay, that chain you will have to remember. So, so stochastic means that cash flow as a exogenous variable, that value is dependent on probability. Okay, students. Now, if you see, they have given us different values and the different probabilities assigned to it, right? So, for example, 10,000, there is a probability of 2%. Then 15,000, there is a probability of 3%, like that. Similarly, for time period also, since in this illustration, they have assumed to be the exogenous variable. So they are saying the probability is 5% that the project will have a life of 3 years. The probability is 10% that the project will have a life of 4 years, like that. Okay. Let's come here. So if you try to see what in this table, the first table here, here what has been done is that the values has been plotted. Just focus on the annual cash flow. Okay. Just focus on the annual cash flow. The values has been taken, the probabilities has been plotted, right? Now we have calculated the cumulative probability. What is the cumulative probability? 2. Then 2 plus 3 is 5. Then 15 plus 5 is 20. Then 15 plus 20 is 35. Then 30 plus 35 is 65. 20 plus 65 is 85. Then 15 plus 85 is 100. I hope it is clear. We have just calculated the cumulative probability. So let's say, what is the 5% probability? So let's say a random number comes as 5. So that will be used in the probability. That means probability is 5%. So for that 5%, what is the value of your cash inflow? That will be 15,000. Okay. So we'll come to this. Then similarly on the project life, also we have calculated the cumulative probability. This one, 5, then 10 plus 5 is 15, 30 plus 15 is 45, 25 plus 70, 25 plus 45 is 70, like that. Okay, cumulative probability is okay till now. Now, students, if you see, these are the random numbers that are plotted. See, there is no sequence in these random numbers. There is no sequence, there is no logic. Whatever has come to, let's say, that it has been calculated. Okay. Now, this column, please refer this column, these two columns. So this says as 2-digit random number. So how it has been structured is, so the cumulative probability till here is 2%, right? So 0, 0 to 1, 0, 0, 1, right? Then this is up to 5, right? So 0, 2 to 0, 4, like one number before, the upper range and lower range. 0.20, so 0.5 to 19. So any number from 5 to 19 will fall under this, is what we are trying to say. Okay. We have done some basis, right? We have done some basis to link our random number with the exogenous variable. Now, what is that basis? That basis is probability, right? And probability has been converted into cumulative probability. So students, till now, are you here with me? Even same thing has happened for the project life. 0.05, like 00 to 004. 15, so 05 to 14. Right. So upper range and lower range, the range, upper limit and lower limit has been defined in that range. Manjunath is saying why year one and two are not considered. Because we feel that year one and year two has 0% probability, Manjunath. So while devising the probabilities, we came to know that year one and year two, the project will never end. It will always end minimum at year three. That is why from year three it has started. Manoj is saying yes. Request everyone also to please let me know whether all of you are with me till now, so that we will just link our last thing here. Okay. Now, the next thing is to look at these random variables. Okay. So what we will do from these random variables, we will pick the first two digits and put it in above table to identify. See, 53. Let me rub everything so that I can just point out on the specific thing. Yeah. So, okay, Suraj is saying, please repeat the meaning of exogenous variable. Anumala is saying okay. Devansh is saying okay. Tanisha is saying, sir, bit confusing, but still fine to take ahead. Okay, Tanisha. Mansha, what are the parameter discount rate 10%? Okay, I will repeat the exogenous and parameter discussion again. But as of now, on the calculation part, you guys just focus. Okay, after this, I will again repeat the parameter and exogenous thing because it is not linked here. That's why. So, see 53. How we have arrived at 53? Just a second. So students, see the heading here, random number 53, right? Where have we taken 53? So read the first random number 53479. So for that, first two digits have been taken 53. Okay. Now, if you see this 53 random number in the annual cash flow table, it comes as 30,000, in between 30,000, right? 53 is falling here, 35 to 64. So hence we have taken 30,000. Okay, you see 30,000. Then next random number of 66. Go to the random number table. Sorry. Then let's go to the year now, right? So the next random number is 97. Let's go to the random number table. See 97. And if you put that 97, it will be here in the time period. And hence the life will be 9 years. Okay, Mohammed, I will do that. Mohammed Abdul Rahim, I will do that. Just wait. So for 97, 9 years have been taken. So now for this first simulation, 30,000 is the cash flow, 9 years is the time period, and hence your NPV is 42,770 with the same discount rate and same cash outflow. That remains same. There is no change in that. Okay. Now let's look at the second simulation. So the second simulation, 66, how it has come? The next random number, 66. On that 66, this comes in 35,000 bracket here. So 35,000 is the cash flow. Then the next random number is 99. 99 for time, it comes here, which is 10 years. So the next simulation, the project life is 10 years. Hence the NPV is there. Okay, students. Likewise, for the 10th, they have done the. Now let me. Okay, Haradas is saying that how 97 has come. So 97 is again coming from a random variable. It can be anything as I explained. Now let me go back to that discussion to tell you. Okay, I will explain it from here again. So students, I'm just recapping the simulation. I will cover everything again. So please focus with me. See, what is simulation? Simulation is repeating the same step again and again on different inputs. for a infinite number of times, let's say 1000, 2000, 3000, 10,000 times. Generally, we use, let's say, Excel or different models to do the simulation because manually we can't do. However, for explaining, we have used 10 simulations in the example. Okay, that is point number one. Point number two, we have to understand that there are two, three things. One is there has to be a random number, first of all. The use of this random number, the use of this random number is it will be used to link the probability, which will be used to arrive at the exogenous variable. Now the question comes, what is exogenous variable and what is parameter? We said that both of them are inputs. See students, this is also input and this is also an input. But parameters are those inputs which remain fixed, which don't change. For example, and this again depends on the decision maker, because if let's say I am doing some simulation, I want that discount rate and initial cash outflow has to be remained same in all the simulation. I will keep them as same because I feel that in none of the simulation those are going to change. I will keep them same. Hence, in this example, that has happened. Now, what is exogenous variable? Exogenous variable are those inputs which are bound to change and are not in my control, are not in the decision maker's control. They are dependent on some probability, which is in turn dependent on the random number. Okay, they are dependent on some probability to happen. So this cash flow is dependent on some probability. And this probability is coming from random number. Simple. Okay, students. So I hope the exogenous variable and parameter is clear. Now let me go back to the example. So students, if you see here, in this, we have been given two things. One is annual cash flow and second is project life. So the annual cash flow and project life are exogenous variables for us because here in example, we feel that these two are bound to change and are dependent on probability. And the risk-free rate and initial investments are parameters for us because we feel that they are remaining same. Right. So first of all, we have tried to capture the range for these different values. And that range is coming from the probability. Correct. Similarly for project life also. Then using these random numbers, these are 6-digit numbers, so don't get confused. We only have to take use of first two digits, right? So the first two digits are taken for both annual cash flow and life, project life, and then the respective value is being taken to arrive at the NPV. So if you see, this is a NPV, 42,770 is a NPV. By taking 30,000 with the 5.759 minus the initial cash outflow. Simple. Because 5.759 is the discounting rate. The annuity factor basis the discounting rate. Gurram is saying one column at the time, take the random number data, first cash outflow, life of the project, repeating the process. Yes, that's what we are doing. Tanisha is saying like 53.97, etc. How did we reach to those numbers and their placements? Okay, 53 and 97 you're saying. So Tanisha, as I said that, see, random number is just random. There is no logic behind it. Okay, if there is a logic behind it, that means there is some biasness and your analysis will throw the biased numbers then. Or if there is a scientific way of arriving those numbers, it will again be a project. We just wanted to see that randomly anything comes, then what will be my output, right? So see, just to explain you, this random numbers have been given in such manner, right? But if you want to try this, you can just simply take any other number also, 1, 2, 3, 4, 6, like that, and 7. So take these two numbers, then 25, 82, 1, 2. Any numbers you take, any numbers you take, and then, or let's say you can take a random number of 12, 18, 02, 05, 99, any number that comes to your mind. Okay. And use these random numbers in the above table. You're getting my point? Okay. So there is no basis for making this. Even if you want to try post this session between today tomorrow, you try in the Excel. So there is a function called random. Excel will also throw any random number to you, and generally it is being used. Okay. Manoj Kumar, how to comment NAV? NAV or NPV, Manoj? I think you would be asking for NPV, right? Because in this we are calculating PV. So NPV, what? See here, your four factors are done. 30,000 cash inflow, 9 years as project life, and then what is the discount? And 1,30,000 and 10%. 1,30,000 as cash and 10% is the discount rate. In that, for the first simulation, can you calculate your NPV? Yes. Likewise, yes, there is a systematic use of random. So, Mohammed Abdul Rahim, I have explained the example, and for benefit of others also, I have explained the distinction between both of them. Robin is saying, is this method simply using available permutation and combination? Yes, Robin, it is using like that. Manoj is saying, understood. Thank you, Manoj. Okay, students, so take some time to absorb this, but this is a very, very, very important thing. Don't think that this is a very theoretical concept. I can tell you from my practical experience, this Monte Carlo. So the simulation process is also called as Monte Carlo simulation, right? This is being used in the valuation of lot of complex things, right? Because the way it does is, it actually so let's say this, okay, let me go back to this table. So if you see, we have 10 simulations here and 10 different NPVs, right? So ultimately, what happens is, if you run this simulation in lakhs of, kind of observations using just a simple Excel click, what happens? Because one only you have to build a model. Once model is built, you just have to change your inputs through random number and output will be thrown and it will be stored in a different table. Now, all these outputs are then averaged out or some statistical operation is done on this. So on these outputs, then we try to see what is the variation, what is the standard deviation, what is the mean of these outputs. On that, we try to rely, and most of the time, the actual is corresponding to these numbers. Okay, so this is a very powerful technique used in the practical life is what I was trying to say. Mancha is saying 002 is this is a two-digit random number combination. Which value random number we can put if we take random number 0, 1, 2, 3, 4, 5. So again, Mancha, I'm saying that since let's say the random table is presented six digits, so what we have done is we have taken the first two digits. You can also take middle two digits, or you can also take last two digits. I am totally okay. And try to do that answer. So what we say is that since we are doing lakhs of calculation, lakhs of simulations, whatever number you take, on an average out, it will be the similar kind of a solution. Hence, we just want to test that randomly whatever comes. So the overall number average should correspond to something. And hence I was telling you that you imagine this calculation happening for lakhs simulation. So you have 1 lakh of, let me go back here. So you have 1 lakh of NPV as output. Agreed? Correct. On that 1 lakh of NPVs, you do mean, you do standard deviation just to see what are the values coming. You will definitely see that standard deviation will be very, very less. And hence, whatever is that mean coming, you will take that as a best possible outcome or the best possible value assigned to it. That is what the outcome. Okay, students. Last thing in this, we also use normal distribution table. I have not touched upon into this. But I'll just spend another 2 minutes telling you what is the use of normal distribution table. So students, some of you would be thinking that how these probabilities have been arrived, these probabilities in the initial table, right? So these probabilities has been arrived a normal distribution table generally in practical life, because we will actually cover this topic of normal distribution table in the subsequent sessions under different topics. But what does normal distribution table does? Normal distribution table helps you to arrive at the value. See, generally what we do, generally we have, okay, let me just put here. So normal distribution table help, if you input probability in this, it will help you to arrive at the value. Okay. So let's say for 10% probability, what will be the value? The value will be, let's say, 10,000 rupees of cash flow. Apart from probability, it takes one or two more inputs, right? Which is mean and standard deviation of that cash flows, right? So we will discuss this normal distribution in detail, right? Although it is not covered even in the till now, but just to tell you out of curiosity that these values are computed using the normal distribution table. Okay, we will cover that in detail in the subsequent sessions. But as of now, please park this. We will, I will try to link this when we will study the normal distribution table. Okay, students. So I give you 10 minutes for a break after this discussion. 8:30 now, we will reconvene at 8:47. Okay, students. You. So in the 1.5 sessions, we have covered a lot of topics, and in the next 1.5 sessions, we will also cover a lot of questions. So before we go that, let's try to do some of the MCQs in between, as we did it yesterday, so that it enforces the revision also. Yes. So let's come to the fourth MCQ. Uh, I hope every one of you can see this, and I expect every one of you to please answer this, right, with A, B, C, D. So calculation of coefficient of variance depends on what all things? Standard deviation, expected return, expected cash flow, or all of the above. Please, students, I request every one of you to answer this with A, B, C, or D. Please express your answers. Yes, Guram is saying D, which is all of the above. Rest all also please post your answers, students. So the coefficient of variation depends on standard deviation A, expected return B, expected cash flow C, or all of the above. Yes, I've got a lot of answers now. Shailesh is saying D, Rahul is saying D, Robin is saying D, Uday is saying okay. So just check once. So the coefficient of variation, coefficient of variance, what was the formula? The formula was the formula used the standard deviation definitely, right? And the formula also used expected return, but somehow expected cash flow will be used to calculate the expected return, right? So hence it will be D, which is all of the above. Next, certainty equivalent approach is guaranteed return from an investment after adjusting for certainty equivalent coefficient, return that is expected over the lifetime of a period equivalent to the net present value, an important concept on decision tree analysis. So students, just think and answer what is a certainty equivalent approach. Which answer do you think resonates more with the concept that we have studied on the certainty equivalent? This is a bit tricky question, but don't get confused. Just simply read and suggest what should be the answer basis what we have studied till now. Whether it should be A, B, C, or D. Perfect. I've started getting the answers. Rahul Kumar Dave is saying A, Guram is saying A, Mohammad Abdul is saying A, Manoj Kumar Pandey is saying, and Robin is also saying A. Perfect. I think all of you are correct. It's A only, students. Very nice. So yeah, let's come back, students. Now in this also, there is this thing that is mentioned is decision tree analysis. Our next topic is that only. Let me come to question number 12, no, 10, 11, yes. Yes. Let's come to question number 10. Before question number 10, yes, I have got some more answers. Dhruv is saying A, Shruti is saying A. Perfect. Students, all of you are correct. I'm happy to see the good numbers. So, decision tree analysis, students. So, students, again, in case of any possible different possible outcomes, this decision tree analysis is very useful. How it is useful? Because we try to build the tree in such a way that whether the outcome will be positive or whether the outcome will be negative. And we try to arrive at the values at the different nodes and take it to the first level. I will explain in detail. Right. We have some questions also, some very good questions also on the decision tree. But before we go there, we just need to understand some of the basics of decision tree. See, somewhere the decision tree will look like this. Okay. Now there is some meaning attached to each and every box and each and every line. So first just understand that what does this square box represents? This represents that this is a decision node. I think node, all of you, what is node? Node is, let's say, a break in the decision. Like after every line, this is also a node. This is also a node, right? So where every line breaks or converts into different possible option, that is called as node. But wherever we put square, this is called as a decision node. That means some kind of decision making is involved, whether we want to do or whether we don't want to do. The circle one, which is B, is actually the chance or outcome mode. So let's say we do this or we don't do this. Okay. So A is a node where we decide that we do or whether we don't do. If we don't do, it will go down. If let's say if we do, it goes to three outcomes. So this is three different chances, right? X, Y, and Z are the possible outcomes. These are the different possible outcomes. But B here, this circle here is a called as chance node. Okay. Beyond which there will be an outcome. I can mention like this. This is a chance node. And beyond chance node, there will be a possible outcome. Okay, Gurram, I don't know, we can change the timing, but we have to stick to the time. Okay, good. Yeah. So coming back, decision tree. Decision tree, I hope some of the basics are clear. Right. Now we will attempt this question and try to understand it deeply, right? So L&R Limited wishes to develop new virus cleaner software. Okay. See, what is this? This is an uncertain situation. We are dealing with a new product situation. You remember my discussion where I mentioned certainty, risk, and uncertainty. Certainty is something which is bound to happen. Risk, there are different possibilities. Uncertainty is something which is not at all we can forecast. We don't know what is the outcome, right? So this is an uncertain situation because the L&R Limited is dealing with a new software development. The cost of the pilot project would be 2,40,000. They are also making it clear that we are doing one pilot. Pilot means small project, not for the overall level. We are doing a small project, and the cost of that small project will be 2,40,000. And then we decide later on whether to roll it out or not. So then they are saying presently the chances of the product being successfully launched on a commercial scale are rated at 50%. So this is also clear. So they are saying if let's say pilot is successful, then we will launch it on a commercial scale. But what are the chances of pilot being successful is only 50%. Correct. Because once the pilot is successful, the next step is to launch it on a commercial scale. Once it is launched on the commercial scale, then only other benefits will come. And the probability of launching it on a commercial scale is 50%. That means the chances of pilot being successful is also 50%. In case it does succeed, L&R can invest a sum of 20 lakhs to market the product. Now see, the second element of cost comes in. It says that after after the success of pilot is announced, then only this 20 lakhs will be invested to market the product and take a full scale commercial scale effort, right? The next step, such an effort can generate perpetually an annual net after tax cash income of 4 lakhs. Then they are telling you that if you go ahead with the pilot and your pilot is successful, Then you will invest 20 lakhs. Then after investing 20 lakhs, you will get 4 lakhs. You see chain events. Every event here will have a second possibility of not succeeding also. Correct? That is the essence of decision tree that we will see. Even if the commercial launch fails, they can make an investment amount of 12 lakhs with the hope of gaining perpetually a sum of 1 lakh. So they are saying if the commercial launch fails, if the pilot is not succeeded, then in that case also they can invest 12 lakh rupees and gain a 1 lakh rupees perpetually. Evaluate the proposal adopting decision tree approach. The discount rate is 10%. Simple. So let's take all the possibilities into the decision tree. Let me put it a bit down. So let's keep in mind what all things have been given to us in the question. So first of all, we are standing on A, which is a decision node. Okay. What is that decision? The decision is whether to do the pilot or not. I'm starting from the very first step. Okay. What is the first step? Whether to do the pilot or not. So there will be two decisions, right? So the first decision is test by spending 2,40,000. Here, do nothing. Correct. I have two decision data points. Sorry, I have one decision data point which have two outcomes. One is do nothing, one is test. Now, if I test, there are two chances, right? There are two chances. So here I will put a chance node, which let's say I will refer as B. Correct. What are those two chances? That this test is successful or this test is a failure. Correct. And in the question, what is the probability that is given? 50-50%. So 50% chances that it will be successful and 50% chances it will be failure. These are the two outcomes. Right. Now, after it is successful, do I again have a decision here? Yes. After it is successful, I can again make a decision. What is that decision? Whether to invest 20 lakhs or do nothing. If I invest 20 lakhs, what I get? I get 4 lakhs per annum perpetually, right? Just see, okay? Then if there is a failure, then also I have two options. If the test run fails, then also I have two options. I have to take a decision whether I invest 12 lakhs and get 1 lakh per annum perpetually, correct? 12 lakhs and 1 lakh per annum, or do nothing. Perfect. The decision tree is fine. Till here, all of you there with me? This is very easy and very simple, students. So with this decision tree, we are able to make it out that what are the different decision making steps which are referred in that square or rectangular boxes, whichever way you want to call it, and the circular nodes are referred to as the outcome nodes, right? Which is, or let's say the chance nodes. So let's say wherever that probability will be given, right? Before that, there will be a chance node. So see, there is no probability here, right? So that is why there is a decision node. But just before this probability, there is a chance node. You're getting that correlation, students? Okay. So this is a decision tree. Now, what we need to do is we also need to understand how this commercially will be calculated, how this commercial calculation will happen, because we have to finally evaluate the proposal also, right? So, student, this is a very small decision tree. In practical life, the different possibilities, the different decisions can, run into thousands or lakhs again. So there are different tools that are used to make this decision tree. But as far as our understanding is concerned, we have to understand the tree and its analysis in a better manner. Now, once the decision tree is created, then we have to work backwards, right? We will not start from A, we will start from the farthest node, which is C here. So at decision point C, what are the two decisions, students? At decision point C, what are the two decisions? The first decision is to invest 20 lakhs and get 4 lakhs per annum. And second decision is not to invest. Here, the preferred choice will be investing. Why? Because if you invest 4 lakhs, sorry, if you invest 20 lakhs and get 4 lakhs perpetually, that means the present value of cash inflow will be 4 lakhs divided by 10%. Correct? 10% is the discount rate. So if I'm getting 4 lakhs perpetually, so that I will divide by 10% to arrive at, let's say, present value of cash inflows, that will be 40 lakhs. Less present value of investment, which is cash outflow, which is 20 lakhs. Net also I'm getting 20 lakhs. So net present value, or we also call it as EMV, right? EMV is referred as expected monetary value. I hope this is clear. So perpetually, if you're getting 4 lakhs and your discounting rate is 10%, that means you can accumulate 40 lakh rupees. The right value to put as of now is 40 lakh rupees. So 40 lakh rupees is your cash inflow. Against that 20 lakhs you are spending. So that means net 20 lakh rupees you are still able to save, which is called as expected monetary value. Now let's come to decision point D. Perpetual savings is what? 1 lakhs, right? So cash inflow, present value of cash inflow will be 1 lakh divided by 10%, which is 10 lakhs, correct? Less cash outflow is 12 lakhs, right? So there is a negative of 2 lakhs. NPV or EMV, by whatever name you want to call. So is it beneficial? No, right? So at decision point D, what is beneficial? Do nothing, not to invest, because if you invest, if you decide to invest, you will lose 2 lakh rupees. Correct? Okay, let me put the decision here. At decision point C, it is better to invest and get annual inflow of rupees 4 lakhs. ठीक है. Then at decision point D, it is not recommended to invest 12 lakh rupees since the cash inflow is on a lower side and the company would lose rupees 2 lakhs. Okay. So this discussion is clear. So let's come to at chance node B. Okay. We are working backwards, right? So C we have understood. Okay, let me just highlight it with some other. So this has to be done in C and D, this has to be done. Okay. Do nothing for D, C, invest. Now let's come to the point number, or sorry, the node at B. So at B, there are two options, right? Or rather, there are two outcomes. One is success and another one is failure. What is the respective amount that you will get? So the amount here we just now calculated, right? 20 lakhs is what we will get in case we succeed, and failure nil. Because in failure, we decided not to invest. So Shailesh, we are coming to that. See, we are working backwards, right? So while we are working backwards, till point C and D, it is after investing that 2,40,000 and hence we are not considering it. Now, once we'll come from B to A, then we will consider that 2,40,000. Okay, Shailesh. So we will consider all the things towards the right of that node. And we will start from the rightest, the one on the extreme right, that node we will start. Anumala is saying, why can't we take the same probability of 50% for C and D also? Because in question it was given as chances of product being successful. Yes. So we will take this 50% now for the purpose of B. As I said that if you're evaluating anything for C, you will take everything after C, not anything before C. Similarly, if you're evaluating anything for D, you will take everything after D. Okay. Perfect. Tanisha is saying clear. Very good. This is nil probability. Probability is 50-50%, correct? For the purposes of B chance node. So the result will be multiply this simply 10 lakhs and 0. 10 lakhs. So this becomes our EMV, expected monetary value. So students, now note, since your expected monetary value at node B is 10 lakh rupees, now let's come to the decision point A. So we have come till here, right? Now this 10 lakh rupees will be compared with 2,40,000. Now let's plot what all decisions we can make at decision point A. We have two decisions. Decision one, invest 1,20,000. Sorry, what is the test amount? It's 2,40,000. Sorry, I mentioned here 120 or 240. 240 only, yes. And return of rupees 10 lakhs. This is decision 1. Decision 2. Invest nothing with zero return, which is do nothing, that second bar. So students, tell me, which one will you choose? Definitely you will choose decision 1. You will invest 1,20,000 and get 10 lakh rupees, simple. Because if you invest 1,20,000, oh sorry, my bad. Again, I've put 120 rather than 240. I don't know why this 120 figure is in my mind. Okay, so invest 2,40,000 and a return of rupees 10 lakhs. So you will definitely go and invest 2,40,000, right? Because by investing 240, you have two chances, right? 50% chance you will succeed, 50% chance you will fail. And if you succeed further, you have to decide whether you want to invest another 20 to get a 4 lakh per annum perpetual amount. And in case you fail, you have a decision to be made saying that whether you will invest another 12 lakh to get 1 lakh rupees per month, per annum. Okay. So the right decision will be to invest 2,40,000 and get a return of 10 lakhs. So this is how the proposal has been evaluated given the different possible outcomes and the different decisions we have to take. Students, still here, everything is clear, I hope. Then we can go on to the next topic. Let's come to the replacement decisions. Okay. So replacement decision, students. So this replacement decisions now has nothing to do with the probability, nothing to do with the different possible outcomes. In this, the question pattern is what? See, you have an existing machinery, right? Let's say the initial years were 10 years. You are standing in between, let's say after the end of 5th year. And because of the change in technology, a new machine, new updated machine is now available, right after the end of 5th year. So you have to evaluate really, you want to take the new machine, whether you want to replace the old machine with the new machine or not. How will you do that? See, there are two ways to do that. One, you calculate the gross cash flow of old and new and compare it, correct? You will calculate at the end of 5th year, you will calculate what is basis the future estimated numbers, you will calculate what is the cash flow of the existing machine, and you will also calculate the new machine related cash flow NPV, right? NPV of old and NPV of new at the end of 5th year to arrive. Or there is a better way to do it, which is you will calculate the incremental cash flows. Now, incremental cash flows will be from two standpoint: cash outflow and cash inflow. Right. Now, how will be the incremental cash outflow? Incremental cash outflow is basically the extra machine cost, correct? Whatever you have to pay extra now minus salvage value of existing machine and plus minus tax amount on existing machine. Let's say you sold the existing machine for a loss that is allowed for tax purposes. On that, you will save tax. That will reduce your cash outflow. Suppose you sold your existing machine at a profit. That will require you to pay more tax. That will mean higher cash outflow. Okay, so that's why plus or minus tax amount on the existing machine. Okay, then cash inflow. I hope this is clear. Correct. This is a simple decision making, logical thinking that I'm putting here. If you want to replace a new machine with the existing machine, for new machine, you will have to see what is the extra machine cost, what is the salvage value that I'm getting that I will reduce because that will be a saving to me, and whatever is the tax treatment on that amount. Similarly, cash inflow, the total revenue that you will get, or any sort of cost savings you will get, right? And the salvage value of new machine that you will get, that is also incremental. After the end of, let's say, 5 years, let's say after the end of 10th year, the new machine also you will sell. So what is the salvage value of that? That also you will get. Okay, students. So replacement decision is more of logical thinking, is more of the facts that are given in the question. Accordingly, we will solve and try to see what is the number coming out to be. We come to question number 11, right? So there is nothing much to explain in the replacement decision. We will try to understand it with the question itself. If you have any other questions, please do let me know. So it says that a company named Robbie's Cube decided to replace the existing computer system. Let us put down all the facts. Existing, new, and incremental. So students, please note that these type of questions have lot of factual data. In your exam or while solving the question, it might be possible that you might miss some of the factual data. So better to put all those factual figures in the form of bucketing, right? I'm putting a bucket. Existing, whatever facts are given, I will put here. New, whatever facts are given, I will put here. And whatever is the incremental thing, that also I will put here. Okay. So it says that a company named Robbie's Cube decided to replace the existing computer system of their organization. Original cost of the old system was 25,000. Original cost 25,000. I'm putting it for my own reference, right? It's not part of the answer as such, but I'm just putting it for my own reference. And it was installed 5 years ago. So time passed is actually 5 years. Okay, I can understand that 5 years depreciation would have already been done on 25,000. Current market value of old system is rupees 5,000. Current market value is 5,000. So today, if I go and sell this, I will get 5,000. Depreciation of the old system was charged with a life of 10 years. So the useful life was 10 years. Time passed is 5 years. And with the estimated salvage value as nil. So while calculating for depreciation, so hence, can we calculate depreciation? Sorry. Depreciation have been 25,000 minus nil divided by 10, which is 2,500. And WDV on 5th year would be 25,000 minus 2,500 into 5, correct? 12,500. This is my WDV, right? These are all logical steps that are coming into our mind. Then depreciation of the new system will be charged with a life over 5 years. Now they're talking about new system, depreciation, 5 years. That means useful life. Useful life for depreciation is 5 years. Present cost of the new system is 50,000. So the cost they have given as 50,000. Simple. Estimated salvage value of the new system is 1,000. Salvage value is 1,000 of the new system. Estimated cost savings with the new system is 5,000 per year. Now this is an incremental data point, right? So cost savings incrementally is happening 5,000 per year. Increase in sales with the new system is assumed at 10% per year based on the original total sales of 10 lakh. So the incremental sales is actually 10% per year. Company follows straight line method of depreciation. This is just FYI. We have also been taking straight line only. Cost of the capital of the company is 10%. So cost of capital is 10% and tax is percent. Now we are required to assess we have to change this or not. Okay, students, let us. So these are points that we have to remember. We will keep on using this as and when needed. Okay. Now let us come to the solution. So let us follow the step. So step one. And these are simple steps that can be applied in any of the situation. Calculation of net cash outflow, right? So this also I'm breaking into two parts. One is cost of new system. What is the cost of new system? 50,000, right? This is straight away given in the question. B. Salvage value of old system. This is also given. This is how much? 5,000. Then C. Tax gain or loss on sale of old system. So this we can simply compute. Salvage value is how much? 5,000 less WDV. WDV was how much? 25,000 for 10 years. Sorry, I'll just mention here 25,000 for 10 years multiplied by 5 years, right? So this was 12,500. So the WDV was 12,500. It at a 5,000. So there is a loss of 7,500. Loss on sale. Loss on sale will be this much. So once we have the loss on sale here, just a second, students. Yes. Once we have lost tax, savings will 7,500 at the rate of 30% into 30%. This is 2250, right? So tax will help me to save 2250. Salvage value will help me to save 5,000 and the initial outflow will be 50,000. So net cash outflow will be 50,000 minus 5,000 minus 2250. Students, I hope it is clear. Larry, I need to check that. I don't know. Check with the relevant person and come back. Okay. So this comes as 50,000 minus 5,000 minus 2250. 42,750. Okay. I hope this is a fair presentation of what we are trying to achieve. Then step 2. Calculation of estimated savings per year. So first of all, change in sales or incremental sales is how much? That is, so in the question, how much it was given? Okay, so like this. Yes, change in sales will be 10 lakh into 10%, right? Yes, which is perfect. Then B will be in operating cost. So we said there is a saving of 5,000, right? This is also a saving. Then C, incremental depreciation. Correct, students? Because for calculating the tax impact, to calculate the incremental depreciation. So that will be calculated how? 50,000 is the cost of new computer. 1,000 is the salvage value. 5 years is the 5 years is the useful life minus old one if it would have been continued. So this would have been the incremental depreciation. So in a way, it means 9,800, 9,500, which is equal to 7,300. Okay. See, students, why we have calculated incremental depreciation just to see the tax impact. Because there will be a tax impact. Okay. Then D, incremental tax impact. That will be how much? So 1 lakh I'm getting extra. 5,000 also I'm getting extra minus 7,300 I'm getting extra in terms of depreciation into 30%. So this comes as 29,310. This is the tax impact, right? This is a outflow. Okay, students. So can I say that now finally cash inflows will be 1 lakh plus 5,000 minus 29,310. Manjunath, we have to now. So Manjunath is saying, I think we should not consider the taxation exact rules. No, we should actually see the intent of question is that if they have given you the tax rate and they have given you the incremental amounts, we should actually consider the impacts, right? Because ultimately, while for all practical reasons, you will end up paying this much of extra tax, 29,310. You're getting the point? Similarly, if you sell your old machinery now, you will be able to save if you take it on a loss. So that savings we have to consider while reducing the cash outflow. So Shruti is asking 25,000 by 10. Why not 5? Because 5, yes. So Shruti, we are trying to calculate the incremental depreciation. So this is the as is depreciation if nothing would have changed. And this is the new depreciation. So this is the incremental depreciation, 7,300. Okay. So what are we left with now? Increase 10% per year. 1 lakh. Okay, now if we total it, 1 lakh plus 5,000 minus 29,310. Otherwise, this would have been just a second, students. Yes, so just a second, students. I think, yes. So this is actually this much. Yes, 1 lakh plus 5,000 minus 29,310, which is around 75,690. Okay, this is the incremental cash flow, students. No, salvage value we will consider, Robin. In the next step, we will go to the salvage value. Okay, I think my bad. I have just because of the comma, it's not 10 lakh, it's actually 1 lakh. Yes, I think that is where my calculation was. Yes, now I think would be right. So students, please note, it's not actually 10 lakhs, it's 1 lakhs, right? So on 1 lakh rupees of sales, so this will be actually 10%. It's not 10 lakhs. I think thanks, Shailesh, for highlighting that. So 1 lakh into 10%, this will be 10,000 exactly. And 10,000, the tax will become now 10,000 plus 5,000 minus 7,300, right? So hence, if I replace everything above 1 lakh from 10,000, so the revised number will be 12,9,690. Okay, students? I think there was a calculation error. Instead of 1 lakh, I assume 10 lakh. That is where the difference was coming. Student, please recheck again this. So Guram is asking, please explain the tax benefit and loss. So Guram, if you see in like depreciation also you get tax benefit, right? Depreciation is what you are amortizing the cost of that asset. Similarly, if you are selling any asset at a loss, let's say your WDV was how much? 12,500 in this case, and you're selling it at 5,000 rupees. So this is part of the step one. Then you will generate a loss of 7,500. Now that loss of 7,500, you will get a tax saving of 30% because you will be able to adjust this against any other profit, and hence your tax outflow will be reduced by 30%. That is the assumption that we have taken. Okay. So finally coming to the third step now, which is calculating the present value of all the benefits put together. Now, what are the total benefits? One is the yearly increase in the cash flow that we have calculated above, which is 12,690, right? I think this will also change. The tax amount will also change accordingly. So the present value of total benefits is 12,690 that you will get plus. This is the yearly income. Then salvage value of 1,000. This we will get after 5 years, correct? So So the present value will be 12,690 multiplied by the present value factor, annuity factor of 10% for 5 years, right? Which comes as, the total comes as, this will be actually multiplied with the present value annuity factor 10% for 5 years. This will not be annuity. This will be a just simply 10% for 5 years, right? So the total will come as 48,270, sorry, 48,723. So the present value of in totality benefits will be 48,000. Yes, so tax impact will be 2310. You're right. 2310. Thank you, Mansha. So hence, in our step number 4, we'll just calculate the net present value. So again, this net present value will be incremental value, students. So the incremental cash outflow in step number 1 was how much? It was 42,750, right? And the incremental cash flow in step number 3 is how much? 48,723. So this will be 48,723 minus 42,750. So in a way, this is 5,973. So the incremental NPV will be 5,973. This is in case we go ahead and replace our existing computer with the new computer. Yes, Guram, I have corrected that. 2,931. Actually, I took that 10 lakhs instead of 1 lakh. That is where the entire calculation misstep has happened. But please do correct all of students on this part. Okay, so this is clear. So I think the concept here is that we have to really put all the facts that are given in, maybe we can different buckets, we can put existing, new and incremental so that we don't miss anything. And accordingly, step-by-step calculation, first we will arrive at what is the incremental net cash flow. For calculating the incremental net cash flow, we will take the total amount as well as we will also compute the salvage value of old system and any tax implications on the old system, or on the old, yes, on the old system in this case, which is the old asset. Then we will calculate the yearly annual cash savings, which will be driven from higher sales, lower operating cost, or let's say tax benefit on the incremental depreciation. And accordingly, we will also get the, while we compute the total present value of the cash inflow, the annual cash inflows plus the salvage value, and accordingly, we will calculate the net present value. Okay, students. Now there is a very interesting case that is given, which is, let's say, and this was one of the question also, if we can compare two different projects having two different life, right? So let's say, let's assume there is a project with 6 years having an NPV of, let's say, 1 lakh. And there is a project of 3 years having an NPV of, let's say, 80,000, right? So we can't really compare these two projects because the useful life is different, because the life of the project is totally different. So to compare two different scenarios or to compare two different projects having different lives, we have a concept called optimum replacement cycle. Okay. So what does this concept says is that you calculate one equivalent annual cost, which is also called as EAC. How this will be calculated is whatever is your present value of cash outflow You have to divide it by the present value annuity factor. Okay. While you do this, you come to know that on a yearly basis, what should be my cash outflow? Correct. So it will create a EMI, or let's say annual EMI of the cash outflow, just to tell you that till what period that amount will be spent. We will again try to understand it basis one of the example, right? But the essence of this concept is that we are trying to arrive at the yearly amounts and then do a comparison. Okay, rather than comparing, because then only this 6 years and 3 years will become comparable, right? Once you arrive at what is the yearly amount for 6 years and what is the yearly amount for 3 years, then only it will be comparable. Let us understand with this question number 12. Okay. So in question number 12, it says that X Limited is a taxi operator. Each taxi costs to the company rupees 4 lakhs and has a useful life of 3 years, right? So they're saying that for one taxi, they spend 4 lakh and it has a useful life which is given of 3 years. The taxi's operating cost for each of the 3 years and the salvage value at the end of the year is given as follows. These are the operating cost and these are the resale values. Correct? So in case we decide to sell after year one, we will get a salvage value of 2,80,000. However, we have to do a operational cost by a of amount 1,80,000. Similarly, year two, these are the operational costs. And if in year two we sell, we get 2,30,000. But cumulatively, we spend on the operating cost 1,80 plus 210. I hope the facts are clear. You are required to determine the optimum replacement period of the taxi if the cost of capital is 10%. Okay, students, I hope this is clear. The question is clear at least. Now, since they are asking us to calculate the optimum replacement period, we first need to understand that if we sell at year one, what are the numbers? If we sell at year two, what are the numbers? And similarly, if we sell at year three, what are the numbers? So we'll calculate NPV. NPV, if taxi is kept for 1 year. That means after year one, we will be selling it. This is the first case. Okay. What will be the NPV? Initial 4 lakh will be an outflow. This is E1 cost. And 1,80,000 will be incurred as an operating cost. But that will be at the year end. So we will discount it by the discounting rate. I am putting a minus because again, it is a cash outflow. 1 plus 10%. Correct. And there is a resale value of 2,80,000 that will be realized. So I will add 2,80,000. But again, this is a 1 year later value. To convert it into the present value, we will do 1 plus 10%. So what is the NPV? NPV becomes minus 309,100. So the second step, if NPV, if taxi is kept for 2 years, what is that NPV? 4 lakh will be the year zero outflow plus 1,80,000 will be spent. Sorry, not plus, minus, because this is also an outflow. Minus 1,80,000, 1 plus 10%, minus for year two, what is the operational cost? 2,10,000. For 2 years, we have to do the discounting. And what is the amount that we will realize on the resale value? 2,30,000. 1 plus 10% raised to the power 2. Okay, students, I hope this NPV calculation for year two is also clear. So this gives us the amount of minus 5,47,100. Okay, students, I hope this is clear till now. Then let's go to the third case, sorry, NPV if taxi is kept for 3 years. This is the third scenario that we can assume of minus 4 lakh is still going to be there, correct? Minus 1,80,000 will still be there, which is the first year operational cost. Second year operational cost will also be there. Third year operational cost will also come now, which is 2,38,000 raised to the power 3. Okay. And after third year, the salvage value is 1,68,000. So in this case, the NPV becomes minus 789,650. Now, students, please note that I'm just putting here NPV and years, right? So 1, 2, and 3. So basically I can say that if the project life is 1 year, assume this is a project, right? So if the project life is 1 year, we are able to get an NPV of 309,100. If the project life is 2 years, we are able to get an NPV of 547,100. If the project life is 3 years, we are able to get a NPV of minus 789,650. Now, students, we just simply can't compare these NPVs. The reason is that years are different and hence the time value is also different. Hence, what has been recommended is that we have to divide by the present value annuity factor, whether it is NPV or in case NPV. In this case, why we are saying NPV? Because we have the salvage value, right? But in case NPV is not given, we can take the present value of cash outflow. That is what is given in the formula, right? Even if you do that, then you will try to get the yearly amounts that will become comparable. Now, what will be the present value annuity factors for, let's say, year one, PVAF, that I think all of us know, right? 1 divided by 10%, which is 0.909. Then for second year, it will be for year one and year two put together, which is 0.909 plus 0.826, which is 1.735. Then for the third year, which will be 1.735 plus the third year uh, conversion factor, which will be total 2.486. Okay, these are just simple present value annuity factors. I hope everyone is there with me till now. If there is some question, please do put. Now, once we do that, we will just take a simply division. So this is called as EAC, right? Equivalent number. So we just simply divide 309 divided by this, 547 divided by this, and 789 divided by this. So the number that we will get is 340,044, 315,331, and 317,639. And these are all in negatives, right? So please remember, these are all negative numbers. So since NPV is negative, so the EAC is also negative. Since EAC is coming lowest for year two, hence it is best to keep this taxi for 2 years, because on an annual basis, the cost will be lowest. If you keep only for 1 year, then the annual cost will be 340. Here it will be 315 and here it will be 317. Since EAC is lowest in 2 years, hence it is advisable to keep taxi for 2 years. Although students, if you see, the highest negative was coming in 3 years, which is minus 789,650. Hence, we were saying that you can't really compare the NPVs of the different years. I think there was one question also on this. If we change the in sensitivity analysis, if we change the period, then I said that you can change the period, but you can't compare the NPVs in that particular case. And the reason is this. Okay. Because if the time period is changing, we have to accordingly compare it using the EAC method. Yes, Shruti, PVAF, it is multiplied if you want to come from future value to present value, right? But in this case, we have present value and we want to go to future value. Hence, we are dividing it. Okay, Shruti? Yes. So now let's come back to over some of the MCQs. Yes. So some of these concepts we would have studied in our previous session and today's session also, but let's cover these MCQs towards the end. So the question is, and we would expect that everyone please answer on your query handle. The risk premium is extra rate of return expected by the investor as a reward for bearing extra risk, equivalent to the rate of government securities, return provided to equity shareholders, or risk-free rate of return. So please select the right answer and share it on the question handle. And this risk premium, I can tell you, is from the topic of RADR, correct? Risk adjusted discount rate, in which we said that RADR has two components, risk-free rate and risk premium. So students, we expect all of you to answer what exactly is risk premium, which is very simple, which is given here. Yes, I think Robin, Devansh, Suraj, Mansha, all of you have answered and it is correct only. So this is risk premium is extra rate of return expected by the investor as a reward for bearing extra risk. Because generally government securities are also risk-free rate of return because there is no risk. While you invest with the government securities, there is no risk. Risk-free rate of return is already risk-free. It can't be. So return provided to equity shareholder is a combination of risk premium and risk-free rate of return. Correct. It is risk-free return plus risk premium. So this option also cannot be, hence the only option left is A. Perfect anomaly. Anumula Sai, A is the right answer. Mansha, yes, correct. Mohammed Abdul, A is right. Manjunath, A. Shailesh, A. This is perfect. Then let's move to the next question. When the risk is high, the cash flow under certainty equivalent quotient is. Yes, this is a tricky question. So students, please do think and then answer. This is a question on CE equivalent. So what do you think? When the risk is high, the cash flow under certainty equivalent coefficient is. What will it be? Okay, so Shailesh has answered A. Devansh, okay. I will not. I will keep it reserved as of now. Let all also please answer. So we are saying here that the risk is high. Then CE approach. Cash flows. What will happen? Whether they will be higher, lower, or no impact, or none of the above. So Suraj, Mansha, Robin, Manju, and Anumula, you are right. So students, please note that what is CE approach? What do we really try to achieve through CE approach? We try to get to the guaranteed cash flows, right? And what are guaranteed cash flows? Guaranteed cash flows are those which don't have any risk element. So if the risk is high, that means the guaranteed cash flows will come down. Correct. So in that example that we studied, 2 lakh was the total cash flow. 50,000 we assumed to be the risky cash flow, and 1,50,000 was the guaranteed cash flow. So the C was 150 by 2 lakh, right? So if you increase this amount, the guaranteed cash flows will come down. So that is what the question is. So correct answer is B. Okay. Which I think most of you are correct. Next question. This is from today's session. Scenario analysis is considered under scenarios such as worst case, base case, best case. This is a very simple question. Yes, students, scenario analysis. I think we covered some of the questions also in today's session on the scenario analysis. This is a very relatively easy question. The option A, B, C, or D, students. Come on. Yes, I think all of you are correct. Mansha, Suraj, Robin, Devan, Shailesh, Manjunath, Anumula, Mohammed Abdul Rahman. Everyone is right. So the correct answer is D. Now the second last question. Sorry, the last question. Sensitivity analysis is useful in decision making because it shows the probabilities associated with each outcome. It tells the user how much critical each input is for the output value. It allows to calculate the probable results under different scenarios. The result of sensitivity analysis are reliable. So students, come on. What would be the right answer for ninth question? This is also relatively easy. Yes, students. For ninth, whether it should be A, B, C, or D. Okay, we have answers from Devansh, Suraj, Mohammed, Abdul Rahim, Mansha, and Shalish. So, Shalish, please recheck your answer. Shalish, please recheck. It should be B. Why? Because we said that sensitivity is a relationship between how much input is changed and what impact it will have on the output. So what is the change in output to every change in input? That is what sensitivity is. Anumula, please check. It's not option A. Okay, tell me what is option C? It allows to calculate the probable results under different scenarios. What do we discuss it today? Is it something similar to simulation, right? Because in simulation, we calculate the probable results under different scenarios. We keep different scenarios, we take different exogenous variables and try to compute lakhs and thousands of the calculations and simulate it. It can be scenario analysis only. Scenario analysis also, Suraj, okay? So perfect. I think this brings towards the end of the session. See, Ashish sir is also there with us. I would request his expert comments to close the session. And sir, there was one question on the November 24.
Yeah,
Yeah.
I have no, already noted it. I'm
Sure,
going
sir.
to reply the same.
Sure, sir. Thank you,
I
sir.
have
Yeah.
noted it.
Uh,
Okay,
yes.
okay, students. I hope you have enjoyed the session very well, and even it was very informative for me too, because I was seeing the concept of right now. The in the end, you have compute this type of this is EAC analysis. So it was a very excellent. So one second, I just want to share something.
Sure, sir. Should I stop sharing, sir?
Yeah, just stop sharing. Yeah, because it is saying you can't see. One second. Now, student, I am just coming to one by one question. One question was regarding theory questions. One student have asked, "Sir, will you cover this theory question?" Oh, before that, I forgot. I was discussing about EAC, equivalent annual cost. Student, if you remember that you have covered this concept in your intermediate level also, where the NPV when we have to compare the project of different years. suppose we have to compare the project of two projects, and there we have one second. There we have to see see there are two projects, say one is 4 years, another is 6 years. Now how to compare this project mutually exclusive, like say, so there we used to use this concept EAC analysis, where we have to see how much because through EAC we came to know which NPV should reserve. One second, student. Okay. Now I think that is better. Uh, Next is a concept. One student has asked about the theory question. Student, so far as the theory questions are concerned, please note that theory questions are basically, of course, you can refer from these classes also, but better source is our own publication, like ICAI study material. There is no shortcut. I came to know some coaching people circulate the short notes, etc. Please avoid these because they are very brief and they are not up to the mark. You should read theory at your own and make key points at note down your key points at your own. Of course, in the end of the session, I will precisely summarize what exactly you can do the one in this regard. Another point is that RTPs. Okay, then mock test papers. So from this, you can understand how the theory questions can be asked in the examination. So student, once you are gone through with the concept, then you will not face any problem. So we shall in the last session, I will discuss with you what will be the pattern of somewhere, what will be the pattern on how the question can be asked. Then you will not face any problem. Now, next question was regarding this is November 2094 classes. Now, student, in the first class, I have told you this class are meant for there's nothing amendment kind of a thing in paper of AFM. So even student who are appearing in November 2024, they can also well attend these classes. They are equally good. Okay, don't worry. They will not be, I don't think there will be any change. And of course, because in my career with the ICAI, I have never seen any amendments kind of a thing. Of course, latest development takes place. You may be aware of the same contemporary development, but there is nothing like amendment like in text paper or law or audit papers, because there are nothing standards are like applicable are there. So you can very well attend these classes. My advice to you, please don't miss these classes. Please continue to attend these classes. And there was one point there when one student is asking, I think in the earlier class, he has also raised his point to change the class timings from 7 to 10 to 6 to 9. I think his name is Guru Ram. Guru
Yes.
Ram, I have noted your suggestion earlier and I will place to my higher authorities at appropriate time. But there are some, this is my opinion, authorities may be considered otherwise. But my opinion is that in Delhi, at today's morning at a 6 a.m., there was zero visibility. So, and for our staff, they are moving and they are living very far off places and they are coming to Noida for making live these classes. So
Right.
it may be issue for them because they will have to leave their home at around 5 a.m. in the morning. However, I have noted your session and I will put forward the same. If possible, then certainly we will take action. And last, if you there was one point regarding you have discussed. There was this point regarding your random number table.
Yes.
So, student, this is point is very interesting. I don't know, Divas, you may be aware that when I passed November 95, when I take up my exam in November 95,
Okay.
so there was used to be a random number table in our examination. There was used to be a provided random number table from where we used to do what their number was written like that. Say 56175. Another number will be 97234. Another number maybe say 10457. So at that time, see, now the trend has changed. There are no nothing tables are provided in your examination. So of course, in the question comes, the random number will be provided to you. Okay. If nothing has been provided to you, so take the random number at your own. You will awarded the marks for the same. You don't have to worry about the same. It has not been provided. Random number means random number. You have chosen at your own. We can't challenge your number is wrong. So in this, I am just discussing. This is not I'm just told out of curiosity. So what we used to do, we used to choose any number. Say, I am choosing two numbers. In a next line, I will also choose second digit and last digit. So my random number will be generated like that: 5657407. So this was a time when used to we have a table. Nowadays there is nothing table are provided in examination. Whatever is provided, that is not mainly in the question paper. So, and in the question paper, if something is missing, like area under normal curve that we will discuss later on. So please, student, don't worry. Just leave the question there. Okay, you don't need to worry about how whether I will lose the marks. No, of course you will not lose the marks in that case. Okay, if no information has been provided, then you. So, student, with this, and in the end, as a custom, I just want to share my contact number with you, and you can send your queries on the mobile app. So you can contact me over the telephone also, and let me check if any student has any other queries so that we can wind up. Just 1 second. Uh, okay, one student is from Delhi and she is saying, कि, sir, इतनी ठंड है. This is very cold. So 7 to 10 is okay. Of course,
Okay.
beta, you are right. But I think we have to take the consider the interest of the other student as well, because of
Right.
course we understand. Anyway, I will put the session of Guru Ram to the authorities, and one mentions some case studies are available. Sir, some case studies on international capital building are available. Should we do it? Student, yes, you can do it, but please, I cannot answer your query right now because this is a quite advanced topic. Right now, I cannot comment on the same. Let me check. Of course, if you are a previous from the previous attempt, then you can attend the same. Okay, student. With this, we are coming to the end of the session. And Devas, thanks a lot for sparing your precious time,
Thank
because you put a lot of efforts, and especially when you shared your uh, logic that why we don't use this in scenario analysis. Why don't we use the this time period? It is
you.
was very good question. Even I want to know the answer.
Sure.
So in the end, when you have linked it with the ESE, it was a very wonderful.
Sure.
Thanks a lot.
So thank
And
you for sharing inside random number. Actually, that was
uh,
thanks a lot for sharing your random number. That was a learning for me also. So yeah,
okay,
random number.
okay, because it is
Everyone
a
gets confused that what is the logic behind that random number. So you clarified there is no logic, there is no scientific way. It's just a
yeah, yeah.
random. Yeah.
It is a nowadays it is on Excel available. It is
Yes.
available on Excel right now.
Yes, sir.
But in our time, there was no Excel. In those
Yeah.
days, computer was maybe it was beyond imagination.
Right, sir.
So in those days, we used to do like that.
Sure, sir.
So and I think it is a mutual, and I think it is a mutual learning, teaching, or a mutual learning and teaching. Okay, okay, Devas, thanks a lot, and
Thank
thanks a
you.
student for your patience listening. Have a nice day, and we shall take up the session in the continue the session same topic in the next class.
Sure,
Thank
sir.
you. Have a nice day.
Thank you,
Okay,
sir.
thank you, Devas. Thank
Thank
you.
you.